Good morning. Welcome to this morning's webinar. This is John McFarland with Miller Johnson's Trust and Estates Practice Group. I am joined with my colleague here, Lori Murphy, who is the chair of Miller Johnson's Trust and Estates Practice Group. Good morning, Lori. I would like to welcome you all and thank you for joining us. We have a presentation this morning regarding charitable giving and the CARES Act tax incentives, which were recently put in place to encourage charitable giving during this pandemic we're facing. I thought I'd go ahead and start off here. We're going to, over today's course of today's webinar, we're going to talk about several topics. And when you see the presentation today, you'll realize this pandemic has touched on so many parts of our society, economy, and the law that is relevant touches on several different practice areas as well. You will see charitable giving discussed today, some employment law matters, and just some general information as well related to business matters, keeping businesses in operation, nonprofits in operation. We'll start off talking about philanthropy in the United States, the history of philanthropy and charitable giving in the United States. We're going to talk about charitable giving and disaster response, coordinating those efforts, making sure that when gifts are made, we're doing it in a way that's efficient, consistent, and coordinated with the disaster response we're seeing at the federal level and the state level, so everything's coordinated. We're going to talk about giving during a time of crisis. And so what Lori and I have focused on in this presentation is primarily to look at ways to make gifts that will get assets in the hands of these nonprofits quickly. So you'll see it's a combination of liquid assets we're looking at in terms of gifts, and also some planned gifts, which can also provide cash to charities now when it's really needed for these charities to have the assets in hand. We're going to go over the CARES Act charitable giving provisions. We're going to go over the Paycheck Protection Program loans, which is also part of the CARES Act. That is being administered through the SBA. I'm sure you've heard of that. It's a very popular program. And we're going to go over that and how that applies to nonprofits. We'll also look at the National Emergency Declaration. That the fact that the president declared the national emergency really opened up a lot of opportunities for employers, employees in terms of taking care of some hardship situations for employees that are impacted by COVID-19. There were also some employer-provided assistance programs available prior to that national emergency declaration, which we will also look at. And then finally, we'll just wrap up with what you can do individually to make a difference and pursue either charitable giving opportunities or volunteer opportunities. So philanthropy in the United States, it's really incredible when you look at these numbers, what we see from Americans in terms of charitable contributions. It's a silent sector of our economy, and it doesn't get a lot of press, but it's really impressive when you look at those numbers. $427 billion in 2018. Giving USA 2019 was published. That Giving USA report is very helpful. It's a lot of good information in there. You can track year by year the giving in the United States. It breaks down the giving by source. A lot of good information there, and you can see charitable giving trends in the United States. But that's a tremendous amount of money, and you can see why it's so important that these provisions are in the CARES Act. Not only does that represent a lot of resources, financial resources devoted to the nonprofit sector, it represents a lot of jobs. There are many jobs in the nonprofit sector as well. So we want to protect those jobs, keep these nonprofits operational so they can do the good work they need to do during this crisis. You will see a breakdown, and I'll show on the next slide how much of those dollars come from individuals, how much comes from bequests, foundations, and corporations. Those are the four areas where you will see charitable dollars stemming from in the United States. So that $427 billion, it's a slight increase when you look at current dollars from 2017, but when you look at it from an inflation perspective, inflation adjusted perspective, it's a slight decline in charitable giving, although it's a very large number, as you can see. On this slide, we look at charitable giving by source in the United States. And you can see the majority of gifts coming in are from individuals. 68% of all giving in 2018 was from individual taxpayers, followed by the foundations at 18%, then bequests at 9%, and corporations at 5%. It's interesting when you look at the corporations, the 5%, that's an increase. That trend is an upward trend. And from a tax policy perspective, very likely that upward trend was due to the 2017 Tax Act, where you see the corporate rates drop from 35% down to 21%. There's a significant jump up from prior years for corporate giving. And as we'll see, there were some provisions in the CARES Act which may even encourage more corporate giving this year in 2020 as a result. Bequests are down a little bit from prior years. Perhaps that has something to do with the estate tax exclusions being so high. But it's interesting to watch the trends year to year to see what is happening. But individual giving is always the largest source of charitable dollars in the United States. And here's a breakdown of the dollar amount of giving by source. You see $292 billion from individuals in the United States. Again, a fact that isn't mentioned often in the press, but I think that's something of which Americans should be very proud. We have a great history in this country of charitable giving, going back to the founding of the country, and it's become part of our culture to have the associations at the local level to make those types of gifts. Private foundations kind of get a bad rap in the news. It's sad to see them characterized many times as tax loopholes, but look at that dollar number, $75 billion. That's something that's really noteworthy and shows you the good that's being done from so many families, corporate foundations that make those grants to charities and do so much good work. Corporations, $20 billion, bequests, $39 billion. Tremendous, tremendous numbers, and really shows the goodness in America and what can be accomplished through charitable giving. So again, not highlighted in the press. You hear a lot about government policy, private sector initiatives, but the nonprofit world plays an integral part in what we do as Americans, and they provide great service for the public interest. So we need to support this, and it's good to see through the CARES Act the incentives to really support these nonprofit initiatives. Going back to the origin of the charitable deduction in this country, we first see the income tax charitable deduction in the Revenue Act of 1917. That act actually was to raise money for the war. They were looking to raise $1.8 billion for war efforts, and the income tax charitable deduction was a part of that legislation soon to be followed in 1921 by the estate tax charitable deduction, and then the gift tax charitable deduction in 1932. So a little bit of tax history there, but those are very important charitable deductions for estate planning purposes or charitable planning purposes. You have to take all three into consideration when doing planning. In taxes, tax deductions are one objective when it comes to charitable giving. Obviously, there are many more factors that motivate individuals to give. Those are the code sections, which refer to the various deductions: income tax deduction, gift tax deduction, and the estate tax deduction. When Lori and I draft documents, we take into consideration all of those because you want to make sure you cover everything in drafting. Very important. These are the tax rates in 2020. The range of the rates go from 10 to 37% for ordinary income tax brackets. You have the 0.9% Medicare payroll surtax. That's for high income earners. So as your income increases, you're going to have that additional 0.9% to contend with. Capital gains rates, they range from 0 to 20%, but once you get into those higher ranges, you have the added 3.8% Medicare surtax. So if you're a top income earner with gain, you're going to be at 23.8% for planning purposes, something to take into consideration. We see the highest exclusions for estate tax, gift, and GST purposes, $11.52 million in 2020. That's incredible. To give you some context, I started practicing in 2000, and the exemption at that time was $675,000 per person. So incredible to see the increase there. Married couple can exclude $23.04 million now. A lot of money. And so you'll see as we progress with the slides here today, those high exclusions provide some great opportunities for taxpayers when it comes to charitable giving. So the objectives when you do charitable planning, you want to serve the public interest. That's what motivates people to do good in this country, and that's what justifies these charitable deductions. It's historically the political philosophy behind the charitable deduction was that you're lessening the burden of government, and therefore charities, by doing the good work, serving the public interest, there should be an incentive to support those charities, and that is the philosophy behind the charitable deduction, both for income, gift, and estate tax deductions. When we do charitable planning, I talk to clients, and there are tax motivations. We want to obviously try to keep taxable income as low as possible, maximize the charitable deductions we've referred to earlier, and then maximize tax-free income. There are ways to do that through some of the plan giving techniques available. We want to reduce or eliminate capital gains tax, reduce or eliminate transfer taxes. Those are all some of the tax considerations that go into play. With the COVID-19 epidemic, perhaps the tax issues aren't as important. People are more concerned about really serving the public interest. But certainly the tax considerations are important to keep in mind as well. So we do things in an efficient way that does the most good for the charities. Charitable giving and disaster response. Here is an important topic when dealing with a crisis. And I got this information from FEMA's website, and it's interesting to see this. They recommend cash donations are the best type of donation. There are a lot of reasons for that, and we'll get to those. Efficiency, obviously. It makes things a little bit easier for the disaster planners. Storage, transportation, sorting through material gifts can be burdensome for our disaster response folks. So cash is the best option, and you'll see that repeated throughout today's presentation. FEMA recommends looking at nvoad.org. That's the website for the National Voluntary Organizations Active in Disaster. So they have that website listed on their website. This organization vets nonprofit organizations that support the COVID-19 response efforts. And the idea here is coordination, right? Not repeating ourselves, tapping into the existing infrastructure so that things are efficient, that we're responding in a manner that's smart and makes sense, and we're making the best use of our resources. They coordinate with HHS, FEMA, and the CDC, which is important. You have the nonprofit sector coordinating with the state and local governments, also the private sector. Everybody is involved in responding to this epidemic, and it's important to coordinate our efforts, given the seriousness of the crisis which we are facing. FEMA also says not to make unsolicited donations of material goods. Now, certainly there are times when we need to make those contributions of material goods, and I touch on that as well in the presentation today. And we see it in the news reports also of what's needed. We've all seen those, but they recommend first and foremost cash donations just for ease of operations, efficiency, so forth. If you look at NVOAD's website, they kind of state the same sort of issues in terms of charitable giving and coordinating with disaster response. They say affiliate with existing organizations. Communities can become overwhelmed by the number of people who want to volunteer during a crisis. So it's important, again, tap into the existing infrastructure and coordinate to make things work efficiently. Volunteers need to be properly trained, properly supported. They recommend not to self-deploy. They also recommend cash gifts as the best way to make charitable contributions. State of Michigan also has good information on their coronavirus website. There is a link. If you go to their website, you can make an online monetary donation to the Michigan Department of Treasury for the COVID-19 Response and Recovery Initiative. The donations go to support critical services for Michiganders that are impacted by the epidemic, and the funds are distributed through the State Emergency Operations Center, their established process, and they focus on the critical needs facing the state. They mention on the State of Michigan's website material gifts, and so perhaps even though everyone's pushing for cash gifts, there may be business leaders out there, businesses that have significant amounts of these items, and they could also help in certain circumstances. Always call beforehand, ask if these items are needed before you make any plans, so that there isn't a hiccup in the planning response. They need masks. We see the N95 masks on the news reports, very critical, necessary. Ventilators, sanitizer, gloves, surgical masks, hospital gowns, no-touch thermometers. And then there's the contact information there for getting in touch with the state regarding these types of donations. You can email or call on that number. Giving during a time of crisis. Here we focus, and Lori and I focused on, again, looking at charitable assets, types of assets that can get money in the hands of these nonprofits quickly. Traditionally in charitable giving, these are the types of assets you'll see: cash, stock, real estate, tangible personal property, insurance, retirement assets, business interests. We touched on this previously. the flexibility of cash gifts, the cost associated with material gifts. It pulls away critical resources for staff and volunteers that need perhaps to be focused on other areas. They get pulled from those areas to handle sorting, packaging, transporting, and distributing items donated, which are material gifts. The CARES Act waived the charitable deduction limits for cash gifts to public charities in 2020, which is tremendous. Previously, the limitation was 60% of AGI for cash gifts to public charities. This is in essence a 100% limitation on AGI for cash gifts to public charities. Again, to encourage these gifts, get the money in the hands of these nonprofits who we need so badly in this time of crisis. Long-term capital gain property. So here's a great possible type of asset to give to charity. Appreciated stock or land held for at least a year and a day. That's the holding period for long-term capital gain property. If you give appreciated stock or property to charity, you can bypass that capital gain, and you are able to deduct the full fair market value of the asset. The gift limit is 30% of the donor's AGI. So if your AGI is $100,000, you can deduct up to $30,000 with appreciated stock or land. If you do make a gift of real property, illiquid asset, if it's over $5,000 in value, you do need to get a qualified appraisal for charitable income tax deduction purposes. If you have questions about qualified appraisals, feel free to email me. I can send you the relevant regulations, but it is important. The IRS wants a fresh snapshot of the value of those illiquid donations so they know that the charitable deduction can be substantiated and justified. Why not short-term capital gain property? Well, you could make those donations to charity, but it's deductible at cost basis only, and the gift limitation is 50% for those gifts of short-term capital gain property. So if you do well and you have appreciation in stock and your holding period is less than 1 year, you're not going to benefit from that appreciation in terms of the valuation of that gift to charity. The service is only going to let you deduct that at cost basis. Something to keep in consideration there for tax planning purposes. If you have securities which have declined in value, you may want to sell those depreciated securities, realize the capital loss, and contribute the cash. Again, if there's 100% limitation for AGI on these gifts of cash to public charities, good opportunity there. If you have a capital loss, that can be used to offset gain on the sale of appreciated assets. If you sell those appreciated assets, that could generate more cash, and you can make an additional contribution of cash to public charity without the percentage limitations. Again, I'll touch on those. That's a CARE Act provision where the percentage limitations are 100% this year for those cash gifts to public charities. This is a very popular piece of legislation, the IRA charitable rollover legislation. You've probably heard perhaps your accountant or financial advisor talk about qualified charitable distributions, referred to as QCDs. Previously, it was difficult to make a charitable contribution to charity from your IRA in a tax-friendly manner. You'd have to withdraw the asset from the IRA, pay ordinary income tax, and then make the contribution. It wasn't a tax efficient way to make a gift to charity with those IRA assets during lifetime. So this legislation came into play. If you're 70 and a half years or older, you can make a gift of up to $100,000 outright to a qualified charity. That's each year you can have that $100,000 gift. That satisfies the required minimum distribution requirement. So a lot of people in this country, the IRA is the biggest asset in their portfolio, and they have charitable motivations, but without this legislation, there really wasn't a friendly way for them to give those assets to charity. If that gift qualifies for the RMD, it's a great incentive for them to get those assets out of the IRA into the hands of the public charity, so they can be used for good purposes. That gift, the qualified charitable distribution, is not included in taxable income. There is no deduction available as a result, but it's still efficient to get the pre-tax dollars directly to the charity for a charitable gift. You can use these IRA rollover gifts to satisfy a previously existing pledge. Again, this is only available for gifts to public charities. Unfortunately, private foundations, supporting organizations, donor advised funds do not qualify for this. It's too bad. Those three types of entities are always carved out of a lot of charitable giving legislation, and I think they unfortunately get a bad rap and get unfairly categorized as tax loopholes. But a lot of good is done with donor advised funds and private foundations and supporting organizations in this country. So I'm not quite sure why that is. They're always carved out, but for some reason they are. But even so, this is a good opportunity this year in responding to COVID-19. If you want to make these types of distributions, it's worth noting RMD is suspended in 2020 under the CARES Act. So although, you know, the motivation for this many times is the satisfaction of that RMD requirement, that's not here this year. But if you like to make these types of gifts, it's still available for this year. Many commentators have suggested possibly making withdrawals, taxable withdrawals from IRAs this year in 2020. The reason being, if there's that 100% limitation for charitable deduction purposes, you're 59 and a half years or older, you're not facing the early withdrawal penalty. If you withdraw that money, make the cash gift with that withdrawal to a public charity, it can be very efficient for tax purposes. So the deduction without percentage limitations allows the taxpayer to offset the income. Now, talk to your advisors before doing this, because your increase in income could have unintended consequences when it comes to Social Security benefits, an increase maybe in your Medicare premiums for Part B and Part D. So a lot of commentators are suggesting this, and it's an interesting idea. It's a great way for individuals to tap into those IRA assets and get cash gifts to charity, but you want to make sure you do it with open eyes and you know all of the consequences here potentially, so you don't have any surprises with Social Security, Medicare, or perhaps other types of benefits you may receive, which are sensitive to increases in taxable income. Donor advised funds, very, very popular giving vehicles in this country. I love donor advised funds. I think they're a very tax efficient way to make charitable gifts. The beauty of the donor advised fund is you can make a charitable contribution to that donor advised fund, get an immediate charitable income tax deduction, but you don't have to designate those gifts right away. You can wait to make grant recommendations to the donor advised fund administrator, and then they make the grant distributions to those recommended grant recipients at a later time. So this is seen many times as an alternative to a private foundation. The startup costs are reasonable. You can get family involved in charitable giving. So it's a great tax efficient giving vehicle, and one where in this current crisis, economic crisis, health crisis, many people have donor advised funds established already. They're easy to set up. If you don't have one established, and perhaps we don't know exactly where the charitable dollars need to go at this moment, we're early on in the crisis, but as things develop, we may have more certainty with respect to where this disease is going to take us as a nation, and we'll be able to be prepared to make those grant recommendations to the donor advised fund administrator and deploy those charitable resources when necessary. I think Lori may have some issues with her audio, so I'm going to just continue.
I'm still on.
Oh, you're here. Okay. Okay.
Yeah.
Didn't know you were there. Okay. Lori, here we have a slide dealing with the donor advised fund versus the private foundation. We get clients who call in often and want to know which one's better, the donor advised fund or the private foundation. And so we've put together these slides to demonstrate the pros and cons of each one. And when I talk to clients, they go, for different reasons, they'll choose one vehicle over the other. The tax benefits, in my mind, are much better for the donor advised fund. They're easier, they're not as burdensome to operate, but you do, I think, from a psychological standpoint, maybe Lori, you've dealt with this with clients, I think that there's a greater feeling that you're making an irrevocable gift, just from a psychological standpoint, because you do make an irrevocable gift, and legally and technically you aren't in control of those assets anymore. You can only make grant recommendations for the donor advised fund administrator to consider. Typically they will consider those and make those distributions, but it is an irrevocable gift to that donor advised fund. The private foundation, I think there is perhaps maybe a little bit more of an element of control for the taxpayer. You're bound by private foundation rules, and they are stringent, and you have to comply, and sometimes it's difficult to comply with those rules. You have to coordinate with your CPA and your attorney to navigate those rules. But it is from a standpoint of the family and the individual who establishes that private foundation, there is a greater sense, I think, of family control and input there, perhaps, with those private foundations. Startup cost is a little bit more expensive for the private foundation, legal and accounting fees, the administrative and management fees, there are tax returns that you have to file annually, the 990 PF. You're very involved with grant distributions with the private foundation. With the donor advised fund, you have the administrator there to do all the internal work for you, vetting the grant recipients, making those distributions of the grants and so forth. No 990 required for the donor advised fund, so that's another thing that you don't have to worry about there. Here we have the slide, and I'll move through these maybe a little bit more quickly, Lori, but we wanted to provide this for all of you as a reference. When you look at these, and you can see the income tax deduction limits are different for each one. The donor advised fund has public charity status, so you're going to have a little bit more of a tax incentive there to go with that vehicle. Excise taxes, private foundation, you can face 1% to 2% of net investment income for the annual excise tax. The donor advised fund is exempt from excise taxes. The value for deduction purposes is set forth there, depending on the type of asset, long-term, short-term. There's a difference in what can be deducted. We talked about control, and I do feel like with the private foundation, there's a greater sense of control by the trustees or directors of that private foundation in the investments and the grant distributions. Maybe a little less so with the donor advised fund, but rarely, and I don't know, Lori, about your experience, but rarely do the administrators not follow through with those grant recommendations. I think that maybe if there was a public policy reason they wouldn't want to follow up on a recommended grant recipient, maybe they would deny it, but my experience has been that they usually will follow through with those recommended grants and the recipients of those grants.
Absolutely. So there's a perception that the donor advised fund gives up a significant amount of control, but in reality, that's just not the case. The donor advised fund really wants to satisfy the grants that the donor prefers to make. That is why they're in existence, and they typically will do all the vetting. And the only times that we've seen them deny is when the charity turns out to not have filed its paperwork, maybe not be an actually qualified charity. So they prevent the donor from running into problems where they shouldn't give a gift to a charity that maybe is out of compliance with the IRS laws. But in general, DAFs are absolutely delighted to follow whatever the donor wishes.
That's a very good point. It is a built-in due diligence mechanism for the donors. I'm a huge proponent of donor advised funds, and that's a very good point. And I do think it's more of a psychological perception on the part of some taxpayers, clients, that they feel like they're giving up control. But I agree with you wholeheartedly there, Lori, that it's a great vehicle and a good alternative for taxpayers when considering charitable giving. Some issues related to privacy there, and I will move through this. We've intended for this to be a resource that you can go back to. Governance issues for the DAF and private foundation, they can both exist in perpetuity, which is attractive for taxpayers and donors. Lori, we're seeing a lot more interest now in charitable lead annuity trusts. A great, Lori and I both deal with high-end estate tax planning matters and vehicles. This is one that's very popular now because of the low Section 7520 rates. The rate was announced, it's 0.8%, which is very low, and a great opportunity for taxpayers now. The lower that Section 7520 rate, the greater that present value of that income tax deduction for the lead interest will be for both gift and income tax deduction purposes. The way this is set up, and I'll go over the mechanics of it, but it's a very efficient vehicle to get assets down to children while still helping charity. Typically, they're funded with a combination of publicly traded stocks, real estate, sometimes some cash in there for the payment of the lead interest of the CLAT. This is a freeze technique, much like a GRAT or a sale to an IDIT. The assets are frozen on the date of the transfer to the trust. So to the extent the trust assets outperform 0.8% in May, all of that appreciation is wealth, which is shifted free of transfer tax down to the next generation. And you'll see here, so the way this works, there's a lead interest, which is paid to charity for a term of years. Upon expiration of that lead interest, the assets are then transferred to children. And as mentioned, it's the low interest rates are good for these CLATs and CLAT planning. You get the larger charitable deduction. You can leverage that lifetime exclusion. So you have 11.52 million per person. There are ways that you can set up these CLATs and pay little or no gift tax when doing so, and you can transfer significant assets to children and get a very large lead interest gift to charities over a period of years. And that's why we mentioned this CLAT. Again, we want to focus on vehicles that can get money into the hands of charities now. And sometimes this is described as a kind of a mini endowment for a charity. You get a payment over 10, 15 years from this CLAT. Usually it's a substantial amount. This is a vehicle you see for people with significant wealth most often, and those lead interests can be substantial. So charities are big fans of CLATs. I don't know, Lori, if you've dealt with terminations of CRUTs. We deal a lot with donors who have charitable remainder unit trusts. One idea here is, again, getting assets into the hands of charity. If you have an income interest in a CRUT, so that you set up a CRUT, you make a gift, usually of appreciated stock or real estate to a CRUT. You receive an income interest. The CRUT assets are valued annually, and you receive a percentage of those assets, which are valued annually each year. The minimum payout is 5% for a charitable remainder unit trust. The remainder is irrevocably committed to charities. So many donors, it may come a time when they really don't need that unit trust income anymore, and they can surrender that income interest or donate that income interest to the charitable remainder beneficiary. If they do that, there's another deduction available for the surrender of that income interest. And what that does, the charity, the remainder beneficiary then owns the income interest and the remainder interest, and through the doctrine of merger, they have the whole interest, and they can then they are no longer obligated to pay out that unit trust income if they're serving as trustee, and they can use the remainder and the combination of the income interest for charitable purposes immediately. Same thing with charitable gift annuities, very popular gifts. If a donor wants to irrevocably assign that annuity income interest to a charity, the charity's thrilled. They get the liability off their books. They can use those funds now for a charitable purpose, and they have money in their hands. The gift annuity, pretty simple vehicle. You make an irrevocable gift of cash or securities in exchange for the promise of a lifetime annuity payment from that charity. The remainder then goes to the charity when the annuitant passes away. You can have 1 or 2 life charitable gift annuities. A lot of different variations there, but the idea is if you want to surrender that income interest, that's a way for the charity to get cash in their hands now to address any issues they're facing related to COVID-19 matters. Lori, do you want to talk about annual exclusion gifts here and the opportunities for individuals?
So 2 things. One, just to go back to what should the message be from charities to their lead donors. The first message, I think, is for those donors who have money in donor-advised funds or private foundations, or who've done more sophisticated planning in the way of a CRUT or a gift annuity. They want to wait till the dollars come back to give them to the charities. We really need to have those donors encouraged to donate now, do it now, because the charities can leverage those gifts and do the most good for the most people when the need is greatest. And so one message that charities should give to their donors is, if you have a private foundation, if you have a donor advised fund, think about making your grants now. Even if your assets have gone down in value, the value of your gift now is so important. And same thing with the possibility of transferring the gift annuity, transferring the income interest in a CRUT. Charities need money now, and that is, I think, a good source of lead donors to assist their favorite charities right this minute. So for people who want to make gifts just to individuals, to their family, to their friends, to their neighbors, how do they do that, and how do they avoid adverse tax consequences on that? So you can give away $15,000 per person per year, and if a married couple you can each give $15,000 per person per year. There's not a charitable deduction because this is not a charitable gift, but there's no need to file a gift tax return. Neither the donor nor the donee, the person who receives the gift, has to pay any taxes on it. So at a time when people want to help others, they can make large gifts to loved ones, to neighbors, to friends, and they can make those gifts without any adverse tax consequences. They can make much larger gifts up to the $11 million exemption amount, and the only consequence is that they would have to file a gift tax return. So there's no gift tax in Michigan or under federal law as long as you haven't used up your $11 million exemption. So for people who want to make gifts that aren't charitable gifts, but are motivated by a desire to help individuals, that's a really good way to do it. Also be aware that direct payment of tuition, direct payment of educational expenses for tuition paid directly to a college, that kind of a gift is not, it doesn't even count towards the $15,000 per person per year. So you could give $15,000 to your grandchild plus pay their tuition. There's also a gift tax exclusion for payments to healthcare providers for healthcare provided to someone you love. So if you have an uninsured family member who's experiencing a health crisis, you can directly pay their medical bills, and that is excluded from that gift tax. And so you could give them $15,000 plus you could pay their medical bills. Again, that's not a charitable deductible gift, but it is certainly a gift that could provide a huge benefit to a loved one. The only caveat is that if the donor, the person making the gift, later on requires Medicaid, that may be a problem for that 5-year look back for Medicaid. I'm going to switch back to John for the charitable gift tax incentives. Go ahead, John.
Okay. Yeah, that's interesting. That medical exclusion can come into play here and be a very important issue if this disease continues to spread. So the CARE Act, again, these I touched on these incentives that were part of the CARE Act, and Lori and I discussed this yesterday. You know, the idea behind the policy of the CARES Act is that, you know, there are 1.3 million nonprofits in this country, and most of them only have 1 month of cash reserves. So they're doing good work, but they're not in a position to have ongoing operations without these donations. So Congress and the president wanted to make sure that there's an incentive for Americans to give to these charities and to give to them now when we really need them, when we're facing this crisis. There's so many good charities out there doing good work, and we want to continue to support them. There's the new above-the-line charitable deduction. So this is for taxpayers who do not itemize. There's a $300 above-the-line deductions for charitable gifts in 2020. These are for cash gifts to public charities. Married couples can deduct $600. So what you're doing is you're reducing your AGI with this above-the-line deduction, which in turn reduces your taxable income. You know, if there are any development officers listening, this might be a good item to highlight for your annual fund pledges, to really reach out to people and let them know, because most people are not itemizing anymore after the 2017 Act. So this is something to really highlight, and it's an opportunity out there. It's not available, unfortunately, again, for donor-advised funds, supporting orgs, or private foundations. Lori, I don't know why that is, but they're always carved out, and it's too bad. Available for cash gifts in 2020, not available for cash deductions carried forward from prior years. So what does that mean? When you make a charitable gift, you have the year in which you make the gift, plus an additional 5 years to carry over any excess. So this above the line deduction is only available for gifts in 2020. You can't use those carry forwards from prior years for that. And we've touched on this earlier, what I talked about, the increased percentage limitation on cash gifts for individuals. The CARES Act limited that Code 170 percentage limitation on most cash gifts to public charities. Prior to this, you could deduct up to 60% of AGI for those cash gifts to public charities. So a great opportunity here in 2020 because of the CARES Act. Again, this does not apply to carryover deductions from prior years, so it's only for 2020 purposes. If the contribution is in excess of a donor's AGI, the excess may be carried over to subsequent years, but will be subject to the percentage limitations in place in the carryover years. So if this only is available for 2020, it's not extended, you'll be back at the 60% of AGI for cash gifts in future years. Not available again for donor advised funds, private foundations, or supporting orgs. You will probably see an increase in gifts from corporations. There was an increase from 10% to 25% of charitable contributions made by corporations previously could not exceed the 10% of taxable income. Now that's raised to 25%, so we might see another uptick in gifts from corporations in 2020. Doesn't apply to private foundations, supporting orgs, or donor advised fund, just public charities. This is important for our estate planning clients, charitable planning clients. 2020, the suspension of the RMD requirements. And my thought, Lori, here, I've heard that the public policy idea behind this was, they look at the year-end balances for purposes of calculating RMD. The market dropped. Perhaps the thought was Congress didn't want to make people take those RMD distributions with that drop in the market. They'll need money this year. As I mentioned previously, that might reduce the incentive to make the qualified charitable distributions, the IRA rollovers in 2020, but still that is available if you do like those QCD gifts to charity. The Paycheck,
and again, for messaging to donors, I think the key thing is we still desperately need the money. And so if you can see fit to make that out of your IRA, any amount is helpful.
I agree. I think the tax incentives, although they're attractive, I think in this environment we're in, if you can make a gift to charity and support them, it's a great idea. They need the help. These Paycheck Protection Program loans are very, very popular. They're in the news. Many businesses are applying for these. I'll get to this, but they've already run through the money that was appropriated for this program. Congress is in discussions about perhaps shoring up the program with additional appropriations. These are available for 501c3s. So if you work for a nonprofit, if you're an executive for a nonprofit, you generally will qualify for these loans. They cover 8 weeks of payroll, benefits, rent, mortgage interest, and utilities. If you adhere to the requirements of the program, there's a potential forgiveness of the loan. The policy purpose behind this, we want to prevent layoffs. We don't want people working for nonprofits to lose their job because of a health crisis that no one saw coming or could do anything about. If you have a significant endowment or a substantial reserves, most likely you're not going to qualify for this. You have to demonstrate that it's necessary that you have those loans as a result of the COVID-19 epidemic. This is issued through the Small Business Administration. The requirement is you have to have 500 or fewer employees. You have to have had employees, paid employees on February 15th, 2020. There are affiliation standards. So what they were trying to prevent was if you had a parent and subsidiaries, they didn't want people to try to fall under the 500 or fewer requirement if they should be aggregated as one organization. So that's what the affiliation standards are focusing on. There was some clarification for faith-based organizations. If there is a similar belief or faith for these faith-based organizations, there is an easing of those affiliation standards for the funding of payroll for religious entities. In the frequently asked questions statement put out by the SBA, there is an exhibit which has a specimen religious organization statement you can look at if you're applying for these loans. We set forth here the requirements. Again, the uncertainty of current economic conditions makes necessary the loan request to support the ongoing operations of the eligible recipient. You have to satisfy that prong. So again, in charities with large endowments or built up reserves, probably going to have a hard time qualifying. That's an important requirement factor. You have to use the funds for those designated purposes: retain workers, maintain payrolls, mortgage payments, lease payments, utility payments. You can't double dip. So the 3 and 4 here, those requirements, you have to be honest, you can't abuse the system there. Again, these are issued on a first come, first served basis. So there was an immediate response when these became available. People applied. You can see this was as of yesterday on the SBA's website. 1.6 million loan applications valued at over $339 billion have been approved. So that $349 billion allocated to Congress for these PPP loans has already been accounted for. They have stopped accepting claims based on those appropriation funding levels. And as I mentioned, there are talks in Congress about additional funding for this program. It's very popular. It is needed right now. A lot of people are out there losing jobs. The National Emergency Declaration by the President, this is really interesting, and more people are taking note of this. Employment law attorneys, charitable planning attorneys. That national security or national emergency declaration by the President really opened up some opportunities for employers to provide tax-free financial assistance to employees. And I want to thank our participant today. We had a question about this program, and we included these slides because of that individual who asked the question, which is a very good question. These payments for financial assistance and employees facing hardship, they are not going to be taxable as wages or income. And the employer can preserve their ability to deduct those payments of financial assistance. Qualified disaster relief payments. So this is under the Stafford Act that allows for this to take place. What is a qualified disaster relief payment? Any amount paid to reimburse or pay reasonable and necessary personal, family, living, or funeral expenses not otherwise compensated by insurance incurred because of a qualified disaster. Under Section 139 of the Internal Revenue Code, the COVID-19 is a qualified disaster. So some great opportunities for employers to provide tax-free financial assistance to their employees. They don't want this to be treated as a wage replacement. The employer can deduct the payments as ordinary necessary business expenses. There's no ceiling on the amount available. The has to be reasonable and necessary. The expense must not be an expense reimbursable by the employee's insurance. Emergency funds designated as private foundations. So this National Emergency Declaration was important for this purpose. Previously, for private foundations, this was not available. Now, because of the national emergency declaration, private foundations may now provide assistance to employees without adverse tax consequences. It has to be an employer-sponsored emergency fund, so it has to be specific for that purpose. You're not going to get caught up in the self-dealing rules or the taxable expenditure rules now because of that emergency declaration. So good opportunity there. This one I thought was very interesting, Lori. Donor advised fund administered by an independent public charity. So if the employer doesn't want to go through the process of setting up a separate entity for the emergency fund, they can work through an independent public charity or donor advised fund. Typically, donor advised funds cannot make grants to individuals, but there's an exception here for funds or accounts established specifically to benefit employees and their families who are victims of a qualified disaster. So interesting opportunity there. They want to make sure you're not targeting individuals. So you can see here, the fund must serve the single identified purpose of providing relief from one or more qualified disasters, and it has to be a broad and indefinite charitable class. Again, there has to be an independent person or group making the determinations of who's to receive those donations, and there has to be, or else there has to be an established adequate substitute procedures to ensure that the benefit to the employer is incidental and tenuous. So some monitoring of the program. You can't benefit any director, officer, or trustee of the sponsoring community foundation or charity. You have to keep adequate records to demonstrate the recipient's need for the disaster assistance provided. There were some opportunities available for employer-provided assistance prior to that national emergency declaration. You could just continue to pay your employees, and payments would be taxable income wages to the recipient. The employer continues to withhold taxes. So that's one option. You can continue to do that. There's also, for larger employers, some of them already had these funds established, these employee emergency financial assistance funds. These were to provide emergency disaster and or financial hardship assistance to employees facing unexpected financial emergencies. So here, the support comes from the employees, and therefore, because there's broad public support, it's qualified as a public charity. You don't have the employer funding it, it's the employees. So the fund can provide financial assistance to any employee who experiences a qualifying financial hardship. Again, cannot simply be wage replacement. You have to look at the individual financial need for each affected employee. If you administer the program properly, the payments are treated as tax-free to employees. So if you have questions on these types of programs, you can call us. We can connect you with our employment law attorneys as well, and look into those programs for you. Lori, do you want to chime in here on how you can make a difference here in this current climate?
Sure. We want to really wrap up with what people can do now. And we've had some great questions, which we've tried to answer. But what can you do now? If you are a donor, contact your favorite charities or contact charities that you see have a need and ask them what you can do to help. So some examples would be hospital foundations, community foundations. Your local community foundations are really trying hard to act as a coordinator of a lot of the donations that are coming in. Faith-based organizations, food pantries, as people are having a harder time getting to the store and getting the food supplies they need. Homeless shelters, funds for first responders. Again, if you look at the FEMA, the Michigan, or even the Grand Rapids website, all of those will have options if you really want to help out the first responders who are doing the best work right now. Volunteer opportunities. If you are a qualified health professional, volunteers are needed to supplement hospital capacity. And it's sad that people have to go on the front line to do that, but bless them for stepping forward to do that. People who have a background in public health or in healthcare fields may be able to volunteer to assist with contact tracing. So if you look at the myvolunteerregistry.org through the state of Michigan, they are trying to coordinate that. One other not so well recognized issue that you can do right now, you can donate blood. So without blood drives out there in the community, there is a huge shortage of blood donation. So if you have the ability to donate blood, please do contact your local blood drive place, and they will assist you. They will be super careful. They will wear masks. They will make sure you wear a mask. They will be super careful and make sure that your donation does the most good for everybody. And obviously, keep doing what you're doing. Keep slowing the spread. Keep flattening the curve. Stay at home. Practice social distancing. Wash your hands. All those things that we're hearing. And we want you to know that at Miller Johnson, we are doing everything we can to assist our clients, to assist people who are in need of legal advice, in trying to help our community. So we are happy to answer whatever questions you may have. Please feel free to send those in even after our seminar is over. We do appreciate your attention and your willingness to spend an hour of your life with us, and we wish the very best, safe, healthy world for all of us. John?
Yes, we do thank you all for participating. I do want to mention, look at the Miller Johnson website. Our attorneys have put together a great website full of information on COVID-19 issues, any topical, any possible legal issue related to the crisis. There's good information there. I encourage you to look at that and contact us if you have any additional questions. And we thank you for participating, and let us know, email us or call us if there are any questions that come up after this webinar concludes. And we will close on that, and thank you for participating.